How does a 72-year-old's life insurance policy terminate after making all premium payments? Well, quite easy actually. See, back in the 80s and 90s when interest rates were much higher than they are now, some less than ethical insurance agents and advisors were setting up their clients with universal life insurance plans being funded at a minimum cost. Now, without getting too technical, I'll explain what that means. Universal life insurance is essentially a one-year renewable term life insurance policy. So at the beginning of the contract, you're being charged rates not far off of what a term policy for that same amount would be. And every year as you get older, those rates increase a little bit. Now, the difference between what you put in to cover those costs and what's left over is then put into a cash account. And that cash account is either given a fixed rate or a rate indexed off the stock market. Now, as an advisor, when I go to plan these types of plans, I'm looking at a few things. What the 20-year average is of the index I want this cash account to be in, what the cost of insurance is going to be on that plan, and what is a solid premium to overfund this plan with, such that even if the market bellies out, this client will never get this type of letter. But back in the 80s and 90s, interest rates were so high that essentially the agents were able to come into a client's home, say they were able to sell a permanent cash accruing plan at term prices and walk out. Because under those projections at those much higher interest rates at the time, they believed that the interest generated on the little bit left over would be enough to well fund that policy. They never took into account any interest rate reductions. And unfortunately, from 2000 on up till now, interest rates have been well below those numbers and really well below average. So essentially at the time, interest rates were so high that insurance agents and advisors were saying, hey, you can fund this plan with very little because we expect all of this interest to be generated on your cash. And now, unfortunately, those chickens are coming home to roost. Now, an ethical advisor could have and should have taken into account the fact that interest rates change and that by paying the minimum cost of insurance on a universal life plan, you're putting the client at big risk of any fluctuations of those rates. And that leads me to one of the bigger issues here, and it still occurs now with universal life plans. Advisors will sell the great benefits of cash accruing, tax-free life insurance plans based off of the indices of the market, and try to do so at minimum contributions to try to compete with term plans, so clients don't see them as too expensive for no reason. Fortunately, these types of plans are still being underfunded today. And that can be okay as long as the client is aware. One of the bigger issues with this story is that these clients never fully understood. I find that still holds true today. Most people never really understood their universal life plan, and it was never properly explained to them, likely because the agents and advisors at the time didn't fully understand them either. So as long as you understand the implications of what you're contributing and how much and what that might mean, then everything's on the up and up. It takes an ethical advisor or firm to take the time to want to do that.